In this video, we're going to prepare a multi-step income statement down through continuing operations. I'm going to try to avoid lecturing on the East or talking about subtle nuances on each of the general line item numbers. That we can save for later discussion. This is purely about the preparation of the multi-step income statement, so we can get that out of the way. All right, so this is a company I'm going to call Scotus Beverages, and they sell bottled beverages of some sort or another, flavored teas or juices or whatnot, whatever you want to say. So in that case, it's going to be, we're going to put the name of the company here, Scotus Beverages, right? Scotus Beverages. And we're going to prepare an income statement. And we're going to say for the year ending, and I'm going to abbreviate it FYE for the year ending. I don't want you to do that, but I'm running out of space here. 2013. All right. So for the year ending, and again, income statement, a little bit of a movie. Now SCOTUS for the year, they had sales of $250,000. They had some return of some of their teas that people did not like. They have a 100% guarantee, so they had some sales returns. And they had some promotional discounts to some of their suppliers, so they had some sales discounts in here. Here are the cost of goods sold, or the cost of the bottles and all the beverages inside the teas that they sell. They have some wage expense, sales, general, and administrative expenses, which you will see me abbreviate as SG&A. Get used to that abbreviation. Research and development costs, because they're always looking for new teas. We will abbreviate this as R&D. Okay. Then we have some sale of equipment, net. The net means that they actually had several pieces of equipment sold, but if we net them all together, they had a $7,000 gain from these sales, because you can see I've used debits here for my expenses and my credits, my revenues, and my gains. Okay, so we had some restructuring charges. We were in one business. We started to go off in flavored coffees, and we decided to restructure that business completely, and we had a lot of charges with it. It's not doing very well. We have some interest income, and we have some interest expenses. We have a little bit of dividend income, and here's some dividends that we paid, and then it gives us the tax rate. So for the most part, let's start then doing the income statement. We start off with sales, and it's going to be $250,000. Now, under that, we're going to have the sales returns and discounts. Sales returns, and our sales returns were $11,000, and our sales discounts were $20,000. Add those two together, $31,000. So we end up with a net sales number of $219,000. Now, I'm going to be honest with you, most companies you look at, they will all have some type of sales returns, and they will all have all types of sales discounts. Most companies do not report this level of detail of information. Most income statements just start off right with net sales. Sometimes they won't even say net on them. They'll just say sales, but they are always net. Okay. The next piece is cost of goods sold, which I'm going to label COGS. Again, another abbreviation you should get used to. Cost of goods sold is $53,000. Another convention I'm going to use in here, I'm going to show all my negative numbers as negatives, just so we don't get confused about whether we're adding or subtracting. So the next line item then is gross profit. Gross profit is extremely important to users because it tells them how much money they make on each item they sell. So if you calculated a gross profit percentage, which is your gross profit divided by your net sales, for Costco, it's going to be around 12 to 14% because that's about how much gross profit they have. If you looked at Coach purses, which with a little bit of cheap cow leather and a little bit of design work, they can sell for $500, $600, $700, even $1,000. Their gross profit is an enormous number. So sometimes that number can give you a firm's pricing power and also can inform you about a firm's strategy. So we've picked up sales. We've picked up our sales returns, the sales discounts, the cost of goods sold. Now, the next section on the income statement is we're looking to create income from operations. Operations are that core business that we do. So Scotus Beverages, what do? They sell beverages. So what are the expenses that are part of their operations? Well, wage expense, right? They have some people they employ, and that's $25,000. And they have their SG&A expense. They have some salesmen. They have some general expenses, their accounting department, and just general administration, the CEO. And they have some research and development. And we're going to put this as part of their operations because it's key for Scotus to continue to develop new flavors, new tastes that appeal to customers to keep sales growth up. So we think this is key. And as manager, I'm going to report that as part of income from as part of operations. Okay, now you have some questions here. These are clear. These are clearly part of operations. The question is, should equipment sales be part of operations, and should restructuring charges be? And again, this depends on the company. Some companies yes, some companies no, and it's always important just to ask the question. I'm gonna make the argument, and I'm pretty confident in it, that sales of equipment should be part of the operating activities. And generally, it's so small that it usually doesn't get reported separately because it's immaterial. And in this case, it's also a gain, right? But we're going to report it separately just for illustrative purposes. But I'm going to argue that it is part of the operations. This is something companies do. They buy equipment all the time. When it wears out, they either dispose of it or they sell it. This is just part of an ordinary course of business for a manufacturing company, and I think it should go in operations. Think of UPS. Lots of trucks bought every year, lots of trucks sold every year. It's just part of their operating activities, and I would say it's part of operating. Restructuring is another issue. If there are some companies that have restructuring charges year after year after year, and I would say that if they do, that should be part of the operating expense section. If they don't, if it's kind of a one-time occurrence, it's kind of unique to that company, then I would say it's not part of operations. And I'm going to say for Scotus, they don't do restructuring every year. They're not continually redoing their business. So this is what I'm going to call income from, I'm going to call my operating income. This is operating income. Okay, and that number is $69,000. And again, this is important to investors because they want to know how much income from the core operations, how much the money they make from selling tea. Now we have this other section we're going to have, these non-operating income and expense items. And as we've discussed, we've made the argument, at least for this company, that the restructuring charge is not part of continuing operations. And again, you would always list the restructuring charge separately, because if a user of the financial statement just wants to change that assumption, they can easily break it out and manipulate the numbers a little bit. The interest income, I am going to show interest, and I am going to report it net. And you will see a lot of companies actually do this. They don't report the interest income and the interest expense separately, but they will report them together net. This was a loss, and because I want to make sure, because this is a gain. This is income to them. Okay, and so this is a typical presentation. Again, for your purposes, you can report them separately, but you more often than not will see this net presentation. They're also going to have dividend income or investment income of $3,000, another $3,000. Okay, so then we have all the numbers in here except one. Well, two, because we don't have anything with the taxes yet. But this number right here, I've kind of just thrown in here just to kind of make you think about it. Again, to point out that dividends paid are not on the income statement. They are not an expense. Any dividends the company pays goes on the statement of retained earnings. and eventually ends up on the balance sheet as part of retained earnings. So we don't want to put these in the income statement. These are transactions with the owners, not the customers. So we're going to call this line here income from continuing operations. Income from continuing operations. I'm going to continuing ops before tax. And that number is $58,000. Okay? So these are all of our operations, both our operating income, our core operations, plus those other charges. And these are ordinary. I mean, these are ordinary charges that are will happen in a company's life. So we want to put that there. The next line item we're going to have is income tax expense. And in this case, we know that the company's tax rate is 30%. Well, if their income's $58,000, we know that from right here, and their tax rate is 30%. We know that the total taxes, I think, is $17,400. So I'm going to show the income tax expense of $17,400. So we're going to have this last line item here is income before. I'm going to abbreviate this. Not a before. Sorry, it's just income from continuing ops, continuing operations. Okay. And in this case, the company has nothing else, so this is the bottom line number. Income from continuing operations, $40,600. And this is the presentation of a multi-step income statement.